All right, let's dive in. Today, we're pulling back the curtain on one of the most powerful and, honestly, most misunderstood forces in the business world, venture capital. We're going to figure out how this whole thing really works. You ever see some brand new company that just explodes onto the scene and you think, wait a second, where did they get millions of dollars to even start that? Well, that's the question we're tackling. And the answer is a wild story of huge risks, crazy incentives, and a relentless hunt for game-changing ideas. So, first things first, let's get on the same page. What even is venture capital? Where does it fit in the grand scheme of finance? Okay, to get VC, you gotta understand that there are two different universes of investing. Most of us know about public equity, right? Stocks. You can buy them, you can sell them, the price is right there on your screen. Easy. But VC lives in the world of private equity. This is investing in companies that are not on the stock market. That means your money is locked up, it's illiquid, and the price, well, that's something you have to figure out behind closed doors. And venture capital is a really specific flavor of private equity. It's not about buying into a stable family-owned business. No way. It's about finding these tiny, unproven, maybe even just an idea on a napkin startups, and betting that they could become the next Google or Amazon. It's the absolute definition of a high-risk, high-return game. So now that we know what it is, let's pop the hood and see how this machine actually works. You might think VCs are just super rich people investing their own money, but that's not really how it goes. The reality is way more structured. The money, the actual cash, comes from what are called limited partners, or LPs. Now, you should think of these as massive pools of capital. We're talking pension funds, managing retirement money for millions of people, or giant university endowments. They give their money to VCs because VCs are the specialists in this one very specific, very risky type of investing. And the people who actually manage all that money, those are the general partners, or GPs. These are the VCs we hear about, the partners at the big-name firms. Their job is to convince the LPs to give them money, create a fund, and then go out and find the startups that are going to change the world. So you can kind of trace the flow of the money here. The LPs put up the cash, the GPs create a fund, which usually has a lifespan of about 7 to 10 years. Then the GPs invest that money into a whole bunch of different startups. If one of those startups really takes off and has an exit, like it gets bought by a bigger company or it goes public on the stock market, the profits from that flow all the way back to the LPs and, of course, the GPs. So how do the VCs themselves actually get paid? Well, it's a two-part deal. First, there's a management fee. It's usually around 2% of the fund's total size each year. That pays the salaries, keeps the lights on. But that's not the real prize. The big motivator, the thing that gets everyone out of bed in the morning, is something called carried interest. After the LPs get all their original money back, the VCs get to keep a big chunk, usually about 20% of all the profits. This structure basically forces them to hunt for those massive, fund-returning home runs. And that incentive, that leads us to the single most important idea you need to understand to get VC. It's not about getting a portfolio of decent little wins. It's about finding a few companies that go absolutely nuclear. It's all about something called the power law. Just look at this. It's absolutely brutal. In a typical VC fund, something like 65% of the companies they invest in will just fail. Poof, money's gone. Another 25% might do okay, maybe they give the money back or a little more, but they're not moving the needle. The entire success of the whole fund, all of it, rests on that tiny little slice, less than 10% of their bets, that become those massive, world-beating companies. And this quote right here, it nails it. The power law explains everything. Why are VCs so obsessed with huge markets? The power law. Why are they willing to fund companies that are losing millions of dollars? The power law. They can afford to be wrong most of the time as long as they are spectacularly right just once or twice. That one win has to be so big it pays for all the losses, and then some. Okay, so if you're a VC and you're hunting for these incredibly rare unicorn companies, how do you even begin to find them? Well, the search process becomes this unbelievably selective gauntlet. And the numbers are just staggering. So let's just imagine a typical year for a VC firm. They might review, say, 2,000 potential deals, 2,000 companies that want their money. Of those 2,000, maybe only 500 even get a second look, or a follow-up call. We're already down 75%. From there, they'll only do a really deep dive, what they call diligence, where they check everything, on maybe 20 companies. And at the very end of all of that, after looking at
2,000 companies, they'll write a check to just 5. From 2,000 down to 5. The odds are just insane.
So how in the world do you become one of those 5? Especially if your company isn't even making money yet. Well, VCs are looking for signals. First, and this is everything, it's the team. Are the founders obsessed? Do they just live and breathe this problem? Next, the market. Is it huge and getting bigger? They call this the TAM, or total addressable market. Then, is your solution a giant leap forward? Not just a little better, but like 10 times better? And finally, can you show any proof at all that people want what you're building? Even something as simple as a long waitlist can make a huge difference.
So we've looked under the hood of the VC machine. We've seen how it works and why they do what they do. And all of this brings us to what might be the most important question of all, especially if you're an entrepreneur. This is the question you really have to sit with. Is this crazy high-stakes game the right one for the company you want to build? And here's the honest truth, the big reality check. Venture capital is not some magical money tree for every business. It's a very specific tool for a very specific job. It's really only a fit for a tiny fraction of businesses out there, probably less than 5%. And you know what? That is perfectly okay. At the end of the day, taking VC money is a trade-off. You're trading a piece of your company, equity, and some control for a whole lot of capital and acceleration. It's like strapping a rocket to your business. It's a path that only makes sense if your business has the potential for that kind of explosive growth. And remember, you're not getting a new boss. You're getting a partner who's going to sit on your board and be just as obsessed with hitting that home run as you are. So that really leaves us with this final critical question that you have to ask yourself. And there's a huge difference here. Are you building a good business, one that's profitable, sustainable, and creates a great life for you and your employees? Or are you building a venture-scale business, one designed from day one for the kind of world-dominating, explosive growth that the VC model demands? Knowing the answer to that is the most important first step you can take.